Imagine giving your clients instant access to trade any private asset, from real estate to private shares, from funds to bonds. You got it! Private markets are 100 times bigger and more complex than crypto. On the supply side, there are dozens of tokenized asset sources, implementing different blockchains, metadata, and flows to solve different use cases and regulations. On the distribution side, there are banks, exchanges, and broker-dealers all over the world. How do we connect them all? The financial industry came together to design FinP2P, an open-source routing and settlement protocol, which Ownera is deploying. Asset sources plug in and simply publish their assets. Ownera aggregates and normalizes the flows and data, giving financial institutions a single API for all digital securities. The result? Assets get global digital distribution and liquidity. Investors get online access to investments, secondary liquidity, and loans against any private digital security. Come on board Ownera, where we take away the enormous complexity of trading private securities from across the industry by giving your clients a unified digital securities wallet.
Just to introduce myself, so Anthony Woolley from Ownera. Before Ownera, 25 years in public capital markets. I think I was joking with somebody in the bar yesterday that however old you are, you say 25, you never go up higher than that number. But many happy years, FX, fixed income, electronic trading at Citi, HSBC, and SocGen, and I was latterly the Chief Information Officer in the UK for SocGen. And we started getting involved in the whole crazy world of blockchain and crypto back in 2014, and as a big derivatives house we were interested in the concept of programmable money and all this good stuff. So worked with hundreds of fintechs actually, and then finally took the plunge. It gets a bit addictive if you're stuck in a big institution, so joined Ownera 2 years ago. What are we doing? We're digitally transforming financial markets, the financial services industry. The industry would say it went through some sort of digital transformation in the 90s with the transformation of electronification of trade floors, etc. But it was really about optimization. And now we're entering a really interesting period where we can transform the industry. So am I on this blipper? So a lot of people here will talk about digitizing assets. We think of the vision even a bit bigger than that, right? If you think about the financial services industry, at the moment it's completely based on accounts, right? You have accounts in the records, the ledgers of banks, financial institutions. They can be bank accounts holding cash, they can be holding securities, whatever, right? And a lot of the complexity of the world that we live in financial services is about moving value between those accounts, right? But they're just records in ledgers, and so ultimately you have a whole load of complexity that's evolved over the last 40 years to enable that to happen with delayed clearing and settlement and intermediaries and making sure there isn't default risk and all this other good stuff. So our vision is that eventually all financial accounts will actually become digital, right? What does that mean? It means that rather than just a record in a ledger, you actually have a digital cryptographic identity for every account, whether that's held by an individual, an institution, or an algorithm maybe. But that digital account can assert its record of ownership over assets, wherever they may be. And if you can tie the two together, bring those two things closer together, so take the digital identity and assert ownership over an asset, then you can make everything direct and instant, and you can start to clean out anything that's not required, that's an intermediary in the middle, and start to enable a new global liquidity. So many of you kind of know this, but many people think of it from the assets side. Well, this is think of it from the accounts side and what that really means. So who needs to deploy these? All financial institutions of various forms, various types. And if a financial institution, we believe, is not starting to get their head around this and convert accounts to wallets, somebody else will. So what's at stake? So I've spent my life in public capital markets, and I often say creating a lot of the complexity and the spaghetti that makes that quite a monster today. The private markets doesn't have all of that legacy. It's basically, as you all know, it's basically offline, and it's the largest market in the world. So this is the area that we're focused on at Ownera. Here's some of the opportunities that we see happening. You can see here 4 major types of private market asset class across the top, and then with each of those, whether that's large private companies, treasury funds, real estate or private equity funds, with all of these we want to unlock both primary distribution as well as secondary liquidity, and also the ability to pledge any of those securities as collateral, which in the old world you talk about sec lending, and in the new world you say DeFi, right? For each of these, you can see on this slide, there's either we're optimizing stuff, which the market already exists. You know, we want to make it better, faster, with less friction in the light green. So you've got a $2.5 trillion primary distribution in large private companies, but there's tremendous friction. If you want to buy shares in Revolut or SpaceX, it'd take you 6 to 8 weeks. And the transaction may not complete. So there's tremendous failure in the pipeline of large private companies. So, and let alone, right, if you reduce the friction there, then you start to transform and get access to this secondary liquidity. Again, secondary market venues for private companies, very high friction. But if you can then, you've got that, and then you can collateralize that, so you can actually start to lend shares, borrow against your shares in a private company, use it for borrowing and lending, you're opening up completely new markets. You can see this as well, treasury funds, ARCA, talking about this because you've got a SEC-registered short-term treasury fund, which is pretty cool because these instruments and forms of investments are so boring and they're so stable, and they have quite a small yield, but you can use them for things like means of payment in this environment, because they're so boring, and then that gets incredibly exciting. So there's all sorts of fun stuff you can do with treasury funds. Many of you know about real estate, biggest market on the planet. And I think there's a lot of people tried to tackle real estate the last 4 or 5 years in this tech space, but it hasn't had the quality assets, it hasn't had institutional engagement, it hasn't had scale of distribution. And that's what we would say is changing right now. Plus, the global economic winds are with us on real estate. We're going into a high inflation environment, so we're back to the 80s. You've got real estate as a good inflation hedge. People worry about public market volatility. Crypto's gone crazy. We think this is the time for real estate. And funds, right, which is actually probably one of the simplest to tackle, but if you could unlock either existing private equity funds or start to digitize funds, then there's a massive market there. So there is tremendous opportunity, as you all know. So what does it take for all of these digital wallets to be able to trade any digital security with every other wallet? It's really simple. No. What does it take to do that? You need wallets that have got a unified API, so we're talking tech now. So a single interface for aggregating and normalizing access to all digital securities from all sources. There's a few tech words in there, but basically you're providing one set of software hooks so that you can get hold and access assets wherever they may be. Oh, no, it does this. Right, so what does it take to build a wallet that can trade any digital security? First thing to understand, crypto is really easy and quite simple. All the data's on the blockchain, and you're largely, if you deal with pure cryptocurrencies, you're talking about effectively bearer instruments, right? If I take a Bitcoin and I transfer it to you, you have the Bitcoin and it's no longer my problem, and it's a bit like people used to run around the financial cities with paper bearer bonds and get mugged and stuff, right? But Bitcoin's a bit like that. That's not the case with securities, right? Securities are complex, and all the data is not there on the chain, and they're not bearer instruments, right? So if I give you a simple example, if I want to send you a Bitcoin and you're sanctioned under the Russian sanctions, I send you the Bitcoin, you've got them, it's not my problem, right? If I've got a security and I send you a security and you're sanctioned, that's my problem. Right? So it's a whole, as you know, securities is a whole other world of complexity. Transactions are not send and forget, and there's a lot of data in and around what we want to do with digital securities. This was, as I say, the only one with bullets. So as I'm saying, massive size diversity of asset classes, responsibilities everywhere, regulatory responsibilities, investor identity and status required, KYC, AML. There's off-chain data required for every security. It goes on, right? International regulations, how do you cross regulatory boundaries? How do you comply? There's a regulatory imbalance all over the world. We don't have a common playing field globally, but we want to open this up at a global level. You have all this fragmentation, right? All of you know here, there's many of you that have tokenized asset sources, and this is now a really exciting area. We have lots of ATSs, and we have people tokenizing all sorts of things. The problem is that there isn't the interoperability and the distribution required to really open that up, and that's kind of what's holding this industry back right at the second, I believe, which is unlike the public markets where you can create a public exchange and you've got the scale of assets and investors and the liquidity you want. In the private markets, nobody's going to have more than 1% of the market anytime soon. And you can create a fantastic, wonderful environment, and you can get things going locally with your assets investors, but you're never really operating at the scale you want to operate at. So we want to unlock that and open up those rails, those distribution rails. So if you're an ATS or you're whatever tokenization venue, you can start to distribute your assets more broadly, and also give your investors access to assets coming from other venues, etc., and do it all in real time and do it all regulatory compliant and all of that other good stuff. So I never quite know if the best or worst analogy. You could say we're the Visa rails of this space, but their fees are quite high, so maybe it's not the best comparison. Or you could say if you're in financial services, capital markets, people would know we're kind of like a Swift and a Fix together, front to back, creating rails for the instant transfer of digital securities. Now, we spend a lot of time on the tech, and we've got fantastic technology to do this, but it doesn't work if you haven't got the industry with you. So over the last couple of years, it's been an absolute core focus of for us to bring together the industry. So every 4 to 6 weeks, I chair a not-for-profit group under Global Digital Finance, a wonderful organization, driving the adoption of some of the tech, the protocol that makes this possible, which the group and Ownera have donated as open source API specs to make all of this work. And that group has the largest TradFi, wonderful word, TradFi. So we have the largest buy and sell side institutions, tier 1, tier 2, the largest exchanges in the world, digital exchanges, and then all the wonderful people who are leading in this space, all the fintechs like Vertalo, like Securities and Tokeny are here, and Invenium, who do data around private market assets, looking at Frank back there, and law firms. So we've really worked very hard to get everybody to start so we can turn this wheel and make this distribution happen. This is the most complicated slide. You were listening to the video at the start. In essence, we have this protocol, this open source protocol, FIN P2P, for peer-to-peer connections between regulated institutions. And in this environment, these rails, every node on the network is a regulated institution carrying licenses for whatever it does in whatever jurisdiction it does. It could be issuers, ATSs, private banks, wealth managers, hedge funds, prime services business, whatever it is. And from this, each of these nodes have the ability to either connect into asset environments, could be disparate tech, we don't care what type of blockchain tech it is, or even it could be quite traditional ledger environments. So saw DTCC here earlier, we've been working with them. They can connect their DSM platform, for instance, through a node in here, big regulated piece of financial market infrastructure. So you can have assets sitting on public blockchains, private blockchains, tokenization platforms, and then the institution that has those assets can then choose where to distribute that to bilaterally to other nodes on the network. Other nodes on the network, other institutions can have investors. They can then choose to onward or not distribute those assets to their investors, right? And of course, for each of these institutions may have assets and investors. So, like ATSs, right? You can make it work in both directions. And it's an ecosystem where as Ownera, we're just focused on these thin rails, and then we want to bring these various parties to this network. So it could include the bringing assets or investors, can be digital custodians, because those single unified wallets at the top, these institutions all have different digital custody solutions. So you could have up here a Citi or a Goldman Sachs, say Goldman Sachs because they're here. So you might have Goldman Sachs wants to deliver a wallet to their clients. They don't want clients to know about tech, so they're not knowing about keys and stuff. They're looking after the keys for them. But Goldman Sachs will decide they might have a preferred custody solution. Some institutions are building them in-house. Others are integrating with tech companies like Fireblocks, that's now worth $8 billion, or GK8, or some of these other companies. So you can choose your custody. You have payment service providers in here. And from those wallets, investors can click to invest, primary. The network supports bilaterally indications of interest for secondary trading. So this whole environment's not an exchange or a matching environment in of itself. It's like a peer-to-peer OTC environment. You can hang ATSs and such parties off of it. And then really what I think in many ways is the really revolutionary side, the ability to be able to pledge assets. And Dave talked about it actually in his vision of the future. It was on his slides somewhere, right? If you can pledge any private asset, again, to lend and borrow, then you're opening up a whole new market. And this network orchestrates those transactions in real time. So, and another important thing here, with all of these environments at the moment that are kind of like islands or walled gardens at the moment, you have to put the security and deal with the payment on the same blockchain. Whereas what you can do here, this routing network can orchestrate between the security and payment leg of a transaction. So you could have an asset sitting on a blockchain somewhere from a regulated institution, and on the investor side, they may have money somewhere else. It could be very traditional, like a pre-funded fiat, where you've got a payment provider here that's giving you like a digital twin of dollars that you have sitting with them in a bank account. Or it could be a stable coin, because institutions are getting a bit more comfortable with those. Certainly the one-to-one back ones, not the algorithmic ones that seem to be doing death spirals at the minute. But you know, they may be comfortable to have like USDC. We connected this directly to Circle for USDC payments, etc. And one day, central bank digital currencies, you just heard about Salvador, and Bitcoin, right? You may be holding Bitcoin in Salvador as a payment mechanism. So here, this network orchestrates between the two in a quite traditional way, actually, the way the banking systems work for a long time. An investor sees an asset. From their wallet, they can see all the assets they're permissioned to see. They could be real estate, private companies, funds, whatever it might be. They see all the information about that asset, make them comfortable to make an investment decision. When they click to invest, through the payment services, their buyer's funds gets locked. There's cryptographically, you assert an update of record of ownership of the asset wherever it sits, and the transfer agent comes back and says, yes, this person is now on a cap table of my company, and then the funds get released to the seller. And that could take as long as 3 seconds, right? You're talking about real-term exchange. You actually go on the cap table of the company and the money gets moved in 3 seconds, boom, right? So it removes a lot of complexity of the public capital markets I've been swimming in for 25 years. This is sort of a brave new world, blank sheet of paper. So as Ownera, we use this FIN P2P protocol to aggregate and normalize all data and flows from all asset sources to give wallets a unified API for digital securities trading across with these functionalities: primary, secondary, DeFi, sec lending, whatever you want to call it. So what does this mean for many of you, right? So if you're tokenizing assets, you get global distribution and liquidity. If you're very happy making your money with your investors in your closed environment, that's great. But if you want added distribution and you want to reach investors elsewhere, and then you, as managing an asset, get fees off the issuance, and the investor on the other side, their institution, gets a fee. But also, one thing about this environment that's quite disruptive, if you're managing the asset, either as an ATS or a financial institution or whatever, and other parties actually trade that in a secondary, so you've got an investor somewhere else having a sell intent to an investor picks up a buy intent somewhere else, you as an asset owner still pick up a fee. So there's a long tail on the secondary that you can pick up wherever your asset is being traded in whatever part of the world. And then if you've got investors, maybe the same thing, but if you're a private bank or a wealth manager or whatever, you can provide your investors with a wallet, with a single API, a seamless API to access these different venues, right? So that's basically what we're doing. Just in terms of where we are, so Ownera's been around 3 years. We've been working very hard to ramp into having high quality assets and investors with quality institutions come into production. So in the next few months, we'll go live with, there's a real estate company we're working closely with in Europe, LRC Group. They got 6 billion euro of real estate under management. They're committed to taking really all of their portfolio and moving it into the digital world. They have relationships with other real estate. We're working with real estate companies in the US. We're working with fantastic companies like Vertalo and Invenium over there, and sure we're working with Goldman Sachs and whoever, Goldman Sachs, Arca Labs. So production, real estate in a few months. Then large pre-IPO companies, we're working with some investment banks that are interested in bringing large private companies. To them, this is like private placements or syndication on steroids, basically. So that's how they think about it, but bringing large private companies to this environment. And off we go. I think that the thing about this is because the network, each node is a regulated institution and each are bringing pools of assets and investors, as you add nodes, you really get a exponential network effect, because as soon as you've got high quality assets, high quality investors, the next institution says either I want access to those assets, I want access to those investors, I'll bring my own pool, and then we think we'll get a force of gravity, and as the Silicon Valley crowd call it, get a flywheel turning. There we go. So that's that. I took just over the 20, but if you're not starving, any questions? So that all makes sense. I threw a lot at you, and different of you will have different perspectives on this world and maybe pick up a different half or two-thirds of the presentation, but let me know, any questions?
How is whitelisting handled in terms of, I want to get my asset from node A to node B? Is that all outside of the Ownera platform, or do you guys handle it?
Yeah, so the protocol and the network understands the concept of, rather than whitelisting, we call it digital claims. Other thing to understand, we don't move the assets out of the environments they're in. A bit like this bearer thing I was talking about with Bitcoin versus securities. We're updating record of ownership where they sit. So you look after an asset, you're never going to lose control of it. But what happens on the network is the asset has lots of attributes, claims, right? This is an asset issued out of this jurisdiction under Reg D 506. Generally, where we are in this world is an accredited institutional world. The technology agnostic, it could do retail or whatever, but in terms of what we can take to production, is that, so it's under these exemptions, it's suitable for these investors, they can't be sanctioned, no PEPs, maybe they can or can't be a US person, etc. On the other half of the equation, investors are carrying claims around I am or I am not a US person, and blah. I had KYC and AML by the institution that's representing the investor. And then when there's an investment that needs to happen or a transaction, there's this marriage between the asset and the investor side electronically to make sure that that transaction can go ahead and settle. Does that basically answer it? Yeah. Yeah.
How do you guys get paid for doing all this work?
Oh, no, we're complete charity, Ownera. No, we're not. So we have 2 or 3 sources of revenue. One is, which is not a major part for us, but is more about commitment to the network, is that institutions taking on nodes, we charge a $50,000 a year license fee, but we know with many large institutions that's about making sure they're committed, right? Because you give them something for free and then they decide they're not going to use it. But the main source of revenue is picking up an equivalence on the value, 10% of the value of the added distribution across the network. So, and it depends on the jurisdiction, et cetera, the way that can work. Etc. US versus Europe.
I'm sure I understood what you just said.
So let me expand. So say you were doing a primary issuance off one environment and you want to reach investors across FIN P2P. You might be taking 3 or 5% on the primary issuance across that network. For that type of asset class in that scenario, we would look to capture, say, 30 basis points of the transaction of primary issuance. Exactly, yeah, but it depending on, because we're talking about a global environment, where you are, the jurisdiction affects how that works, and also the amount depends on the asset class, right? So you're not going to get very far taking 30 basis points on a short-term treasury fund transaction, right? So obviously it depends on whether you're talking primary, secondary, what type of asset, if that makes sense. And then, so that's Ownera. On maybe your side, I don't know what you do, but on the asset side, we're not strictly determining this network will find its commercial levels. But in principle, you have a symmetry whereby somebody's got an asset. When they issue it, there's you've got a fee, and on the investor side, there's a fee for the institution with the investor. So everybody's happy. Does that kind of make sense? Yeah.
So, as you know, I think this is brilliant, but what sort of pushback do you get from the community if you're trying to sell it?
So we are talking, like I say, this large industry group, we're talking to all sorts of institutions that might want to run nodes. There are really two types of people in this world. There are people that think they're building a walled garden, right? And they say, we're going vertical, right? So come to us. We've got assets, investors, method of payment, custody, blah, 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 blah. Happy days, right? We're not so good at selling to them, right? But there's a lot of other people like at this conference that understand that this is the largest market on the planet. A rising tide floats all boats, and the way that this is going to start to really happen is to open up distribution, for everybody to collaborate, to open up distribution. So on one broad level, to answer your question in the main, there's that big conversation. Either a company does or doesn't have this mental model that, you know, we're open for business, we want to open up distribution between these companies. Then people have loads of questions about how does it really work in practice, how does the regulation work, how does this work, how does that work, and then we work through that with people. But we haven't found many questions that kind of completely stop us in our tracks. Any other questions? So obviously happy to, as always, to engage with any of you. I lug that massive sign out there from New York in 2 holdalls, and I got business cards there. Do talk to me if you're interested in finding out more. All right, thanks. Thanks.